I want to talk about something that Dodd-Frank did, because it created the Consumer Financial Protection Bureau, which conservatives as well as some centrist Democrats, Mr. Chairman, have argued has gone too far. And yesterday, the House of Representatives voted overwhelmingly and following suit from the Senate to roll back a specific provision with regards to the auto lending industry. Could this potentially, one, end up on the president's desk within the next week, and two, be the start of more steps in walking back the consumer agency created under Dodd-Frank?
Well, certainly I hope so. Yesterday was a good day for the rule of law. It was a good day for consumers. It was a good day for freedom. The Bureau of Consumer Financial Protection, the Bureau as we call it, is still probably the most unaccountable, powerful agency in the history of our republic. And we need to be, as a nation, committed to the rule of law. So here's the problem with what the Bureau did. They passed a broad, sweeping rule de facto, although they did it under the guise of something called guidance, that essentially would prohibit auto dealers from taking a wholesale financial product and using their discretion to sell it retail. Well, there's several problems with that. Number one, the Dodd-Frank Act made it illegal to regulate auto dealers.
Yes.
Number one, it was illegal. Second of all, it hurt consumers. An analysis by the Wall Street Journal indicated that particularly borrowers that had better credit scores could pay up to $586 more.
But if you're an analyst on Wall Street, or you're watching this in Europe, for example, and you look at what's happening in Europe, Mr. Chairman, where we're seeing the banking regulations dramatically increase, and right now in the United States, we're seeing them weaken or be rolled back or whatever you want to call it. If you're trying to sort out sort of the direction of where the U.S. is going to continue on down, what should people know in the next 6 months before the midterms?
Well, I think what we're seeing is a recalibration. We're adding some common sense. I think under the Trump administration, you're going to see a very pro-growth deregulation policy. I'm very happy that Congress, working with the Trump administration, I believe created a 3% growth tax policy, but we don't yet have a 3% growth regulatory policy. And what you're seeing today is under something called the Congressional Review Act, where we can essentially whack back bad regulation with the cooperation of the administration. You're seeing the Congressional Review Act used aggressively under Speaker Ryan, under President Trump, in a way that's really going to benefit the economy and help get us to sustain 3% economic growth.
Because that Congressional Review Act is really something that is the tool in which lawmakers can use against agencies. What's the next thing that is on the list to use the Congressional Review Act for?
Well, we're examining that now in the House Financial Services Committee. I'm very proud to say the very first time the president lifted his pen to sign a Congressional Review Act into law, it came within the jurisdiction of our committee, and I was there. So this particular auto lending guidance is going to be the next, but we're examining the General Accountability, Government Accountability Office has given us a whole new universe of guidance that was promulgated by the Bureau, and so we're examining those to see what potentially could be next.
2 more questions for you. First and foremost, Budget Director Mick Mulvaney, Acting Director of the Consumer Agency now, has plans to revamp the agency and how it works, and we're hearing that could happen as early as this week.
Well, it can't happen soon enough for me.
Well, have you spoken with him about when we might get new developments on when and how he's going to restructure that agency? Well,
I have spoken to the Acting Director, Mick, as I know him, and said, Mick, what's the holdup? We need to get moving here. And again, consumer protection is very important. What we want are very vibrant, competitive, transparent, innovative markets, vigorously policed for fraud and deception. So we want our consumer financial protection laws enforced. The problem with the Bureau under Mick's predecessor was that they were making up the law, and they were doing it in a way that hurt consumer freedom, that hurt consumer choice, that hurt markets. It was the arrogance and hubris of government, and it hurt economic growth. It caused free checking to be cut in half at banks. It caused credit card offerings to go up by 2 percentage points. A lot of bad things happen to consumers. Under Director Mulvaney, we're going the opposite direction.
Mr. Chairman, as we're talking about this, Deutsche Bank reportedly considering laying off 20% of U.S. staff. There's a major piece of legislation in the works, obviously, from the House or from the Senate that has advanced on tweaking Dodd-Frank. Is there any update on timing about when that Dodd-Frank overhaul or fix-it bill, call it what you want, might get floor time or a vote in the House of Representatives? Do you have any comments on Deutsche Bank?
Well, sooner as opposed to later is when I think we will see the Senate Bill 2155 come over to the House. I'm very proud to say that when you look at its deregulation provisions, probably 2/3 of it, maybe even 3/4 of it, started from the House. Personally, I have been holding up the bill because we have many other bipartisan provisions I would like to have included. The Senate has let it be known that they didn't want it included in the bill, but they did give myself and the Speaker a commitment that they would allow our other bipartisan capital formation provisions to go to the floor. With that commitment, I personally released 2155 for floor consideration. The majority leader will make the actual decision, but it could be on the floor as soon as next week or the week thereafter. But that's a decision he will make.
As soon as next week or the week after.